The year was 2008, and millions of Americans watched helplessly as their retirement accounts were cut in half while simultaneously losing their homes to foreclosure. Fast forward to today, let me take you back to a conversation that happened inside the corridors of power just weeks ago. A senior economic advisor to the Trump administration was sitting in a closed-door meeting with housing policy experts. And the question on the table was simple but profound. How do we solve the housing affordability crisis without creating another 2008-style bubble? The answer they arrived at was controversial, innovative, and potentially dangerous all at the same time. The proposal would allow Americans to withdraw funds from their 401k retirement accounts without the typical 10% early withdrawal penalty, specifically for the purpose of making a down payment on a primary residence. On the surface, this sounds like a dream come true for millions of young Americans who have been priced out of the housing market. They've been saving diligently in their retirement accounts, watching that balance grow, while simultaneously seeing home prices climb faster than they can save for a down payment. This plan would theoretically kill two birds with one stone, allowing people to use money they've already saved to achieve the American dream of homeownership. But here's where the story takes a turn that most people aren't talking about. When you withdraw money from a 401k, even without the early withdrawal penalty, you still owe income taxes on that money. If you pull out $80,000 for a down payment, you could be looking at a tax bill of $20,000 to $30,000 depending on your tax bracket. That's money that needs to come from somewhere. The political motivations behind this proposal are fascinating when you dig beneath the surface. The Trump administration has been under enormous pressure to address housing affordability, especially among younger voters who feel like homeownership has become an impossible dream. Traditional solutions like building more housing or reducing regulatory barriers take years to implement and face massive local opposition. But a policy that lets people use their own money to buy homes can be implemented relatively quickly through regulatory changes or legislation. And it comes with a compelling political narrative. We're not giving you a handout, we're giving you access to your own money. Critics have been quick to point out the potential downsides, and their arguments are worth considering seriously. First, there's the retirement security issue. Social Security was never designed to be the sole source of retirement income. And with the program facing long-term funding challenges, Americans need robust personal retirement savings more than ever. Encouraging or enabling people to raid those accounts for home purchases could create a generation of retirees who own their homes outright but have no cash to live on, leading to a wave of reverse mortgages and eventual foreclosures among the elderly. Second, there's the housing market impact that nobody wants to talk about openly. If millions of Americans suddenly have access to their 401k funds for down payments, what happens to home prices? Basic economics tells us that when you increase the pool of available money chasing a limited supply of homes, prices go up. Some economists are quietly warning that this policy could actually make housing less affordable in the long run by inflating prices, benefiting current homeowners and real estate investors, while ultimately hurting the very first-time buyers it is supposed to help. It's the same dynamic we saw with student loans. When the government made more money available for education, colleges simply raised tuition prices to capture that additional funding. The housing market could follow the same pattern, with sellers and their agents adjusting prices upward the moment they know buyers have access to larger down payments through retirement account withdrawals. There's also a fairness question that deserves attention. Now let's talk about the mechanics of how this would actually work, because the implementation details matter enormously. The current proposal being discussed would apparently allow a one-time withdrawal up to a certain limit, possibly $50,000 or 10% of the account balance, whichever is less. This would be restricted to first-time home buyers, though the definition of first-time home buyer in federal programs is surprisingly loose, typically meaning anyone who hasn't owned a home in the past 3 years. The money would have to be used within a specific time frame, probably 120 days, and would need to be documented as going toward a down payment and closing costs on a primary residence. Investment properties and second homes would be excluded. The tax treatment remains the biggest question mark, with proposals ranging from full, immediate taxation to spreading the tax liability over 5 years, to potentially even offering some form of tax credit to offset the burden. Each of these approaches has dramatically different implications for both individual taxpayers and federal revenue. There's a historical precedent worth examining here. In the late 1990s, Congress passed legislation allowing penalty-free withdrawals from IRAs for first-time home purchases up to $10,000. That program still exists today, and studies have shown mixed results. While it did help some people achieve home ownership sooner than they otherwise would have, it also contributed to the housing bubble by putting more buyers into the market. And many of those who used the provision ended up with inadequate retirement savings later in life. The key difference with this new proposal is the scale. $50,000 from a 401k is vastly different from $10,000 from an IRA, both in terms of individual impact and potential market effects. The retirement planning industry is watching this proposal with a mixture of horror and fascination. Companies that manage 401k plans would face new administrative burdens, needing to process these withdrawal requests, verify they're being used for qualified home purchases, and manage the tax reporting. Some providers are concerned about the precedent this sets for further erosion of retirement account protections. If we allow penalty-free withdrawals for home purchases today, what comes next? Withdrawals for education expenses, for starting a business, for medical emergencies? Each exception sounds reasonable in isolation, but collectively, they could transform retirement accounts from protected long-term savings vehicles into general-purpose savings accounts that people constantly raid for various life expenses. The real estate industry, predictably, loves this idea. The National Association of Realtors has already signaled support, seeing it as a way to bring more buyers into the market and sustain transaction volumes that have been declining due to affordability challenges. Mortgage lenders are similarly enthusiastic, recognizing that bigger down payments mean more qualified buyers and potentially lower default risk. But homebuilders are more cautious, knowing that unless the supply side of the housing equation is addressed, increased buying power will just bid up prices on existing homes without spurring new construction. There's a generational divide in reactions to this proposal that reveals deeper tensions in American society. Older Americans who bought homes decades ago when prices were a fraction of current levels tend to be skeptical, viewing this as irresponsible raiding of retirement funds. Younger Americans, particularly millennials and Gen Z, tend to be more supportive, seeing it as one of the few viable paths to homeownership in an economy where wages have stagnated while asset prices have soared. This generational conflict over housing policy reflects broader disagreements about economic opportunity and fairness in modern America. What makes this proposal especially interesting from a political standpoint is its bipartisan potential. While it's currently being advanced by Trump advisors, the underlying policy could attract support from both parties. Republicans like the emphasis on personal responsibility and using your own money rather than government subsidies. Democrats might support it as a way to address housing affordability and wealth inequality, since home ownership has historically been the primary wealth-building vehicle for middle-class American families. The political calculation is that most voters won't think through the long-term retirement implications. So what's the right answer here? Should this policy be implemented, modified, or rejected entirely? The honest truth is that it depends entirely on your individual circumstances and values. If you're someone who places enormous value on home ownership, views your home as your primary investment, and believes you can make up the retirement savings shortfall through other means like increased savings later, business ownership, or inheritance, then using your 401k for a down payment might make sense. But if you're someone who values retirement security, understands the power of compound interest, and worries about having enough money in old age, then leaving your 401k untouched and finding other ways to save for a down payment is probably the wiser choice. The problem with making this option available is that it forces millions of Americans to make a complex financial decision that will have consequences decades into the future. And most people simply don't have the financial literacy or advisory support to make that decision well. And we're potentially setting up a situation where people make emotionally satisfying short-term choices that lead to financial disaster in retirement. The Trump housing plan to allow 401k money for down payments represents a fundamental question about what kind of society we want to be. Do we prioritize home ownership as the ultimate symbol of achieving the American dream, even if it means sacrificing retirement security? Or do we protect long-term financial stability, even if it means more people remain renters longer? There's no obviously right answer, and reasonable people will disagree based on their values and circumstances. What's clear is that this proposal, if implemented, will have profound effects on housing markets. Retirement security and wealth accumulation patterns for decades to come. The advisor who revealed this plan probably didn't anticipate the intense debate it would spark, but that debate is exactly what we need. Before any policy like this moves forward, Americans deserve a full and honest discussion about the trade-offs involved, not just the appealing headline of using your own money to buy a house. Your financial future may depend on understanding what's really at stake here, because once you make that withdrawal, there's no going back, and the retirement you're sacrificing today might be the poverty you're accepting tomorrow. The choice, as always, will be yours to make, but make it with your eyes wide open to both the opportunities and the risks.